Thanks everybody for joining me today. My name is Brent Moors, and it is time for Exploring Thinkorswim. I'm glad you've joined us, whether you're live or in a recording. My name, as I mentioned, is Brent Moors, and you can follow me on Twitter or formerly known as Twitter, X, at Brent Moors CS. Today, what we're going to talk about, we're talking about backtesting options. Now, if you're not an options trader, hey, that's okay. Stick with me. I want to show you kind of about a cool tool called thinkback on thinkorswim. And if you don't know anything about options, we'll give you kind of an intro on some things of it. Of course, we do have other webcasts, such as getting started with options, that you can check us out on. But if you are an options trader, I think you're going to find this to be a valuable tool. So stick with me here. Now, before I get too far into this, let me just mention a few things. Options do carry a high level of risk and are not suitable for all investors. The information today is for general informational purposes. It should not be considered an individual recommendation of a security strategy or chart type. Schwab does not recommend the use of technical analysis as a sole means of investment research. And the paper money application is for educational purposes only. Let me just check on one thing. Looks like we have Barb in the chat here today. Do appreciate Barb here. Past performance of any security or strategy does not guarantee future results or success. And I mentioned earlier, hey, you can follow me on X. You can also follow Barb on X at Barb Armstrong CS. One note on X, and that is there are some imposters out there. So make sure there's no underscores in it's just first name, last name, CS, at Barb Armstrong CS. It's not at Barb Armstrong underscore CS or Barb Armstrong CS underscore. It's just at Barb Armstrong CS, at Brent Moors CS. Past performance of any security strategy does not guarantee future results or success. Okay, let me head on over to the thinkorswim platform. And this is a little bit more of an intermediate level webcast. Okay, so if you're brand new, that's okay. Just realize I'm going to assume a little bit of prior knowledge here. But I want to talk about a few things today. Backtesting, number one, and number two, using the thinkback function. All right, so what's backtesting? Backtesting is using historical data to try and find out the profits or losses on individual trades. Now, they can be stock trades or they can be options trades. So just realize they're both there. You can use either one there. And so that's what we're going to do today. I want to talk about both of those things, backtesting stocks, backtesting options. So I want to start first with backtesting stocks and backtesting in general. The thing is, if you're doing backtesting, why would we even do backtesting? Well, what's the purpose of paper money well, here's the thing. By backtesting, it allows you to go back historically and check how maybe a particular system that you have in mind, a particular approach to investing you have in mind has worked. You can see it historically. Now you can forward test, and that is just basically do trades in paper money. And that is fine, but the problem is for some of these trades, let's say you want to test a strategy that's going to take 6 months. Well, you enter the trade today, you're not going to have any results for 6 months. That's like an ideal situation for testing, but if you'd want to test a lot of data points and be able to do those a lot of data points without having to wait 6 months or whatever your time frame is, then backtesting is a great way to start to see the success or lack thereof of any strategy that you do. Now, one of the little disclaimers that we always say is past results don't, past performance does not guarantee future results. That's true. So a system you can create a system that backtests very well that maybe it's not going to perform very well. So there's no guarantees here on that. So that's the first thing I want to know. But I really like the ability to do a lot of different testing over a shorter period of time. There is a problem though. There's a challenge that we have though, and that is back testing. It's easy to kind of cherry pick data points. In other words, let's say I were doing back testing on, let me pull up NVIDIA just as an example here. And I go right here. Let's go right. This is a 5-year chart, by the way. I have a 5-year daily data. And I go right to this point right here. And I look at this and go, oh, how's my system? How's this long system going to work if I do that? Well, it's going to work out pretty well because I intentionally picked a spot on the chart where it was going up. You're probably better off instead doing this. You can go back and make sure you have daily data on there, but go to a long-term time frame. I'll go 10 years. I'm going to go back 10 years. And I'm just going to kind of randomly, I'm going to zoom in to a certain spot, okay? It doesn't matter if I see that spot, but then what I can do is I can go forward in time, okay? And I can just say, look, I just kind of randomly here, I don't know where I'm at, okay? So I'm going to go randomly in time, and anywhere in the 10 years that I went to, I have a 10-year, one-day chart here, but I'm zoomed in, and this is for stocks here. And then I can just implement my system because I don't know. I didn't see what's going to happen next. It may go in for a big bear market here right now, but let me go for it. And for our purposes today, FYI, I have a 30-day simple moving average and a 10-day exponential moving average on here. Okay. Now, this is a fairly common type system, but it's just meant to represent whatever system that you use. I'm going to wait till I get a bullish cross on that before I consider it an entry. Well, right now we've had a pretty good, I happen to zoom in right in an area where if we got in here, it would have been really great, but we're not going to do that. We're going to wait until we get the next bullish cross. So okay, so here's the next bullish cross. By bullish cross, I mean the 10, which is in green, crosses above the 30. So I'm going to go to that day, and I can look at whatever day it is on the chart right up here, and I can go right there, and I can say, oh, on 9/28 of 2020, I'm going to enter that trade. Jot down 9/28 to 2020, and let's say it's just a stock trade, and I'm going to get out when I get the bearish cross. Oh, here's our bearish cross right there, and on 10/28. So we were in exactly a month there, basically, on that. And I'm going to jot down that price. And I'm going to see the difference between this price and the difference between that price and mark it down on my sheet. And then I'm going to go to the next data point, do my next bullish cross. This was just one day. I'm going to wait for that. And so now we get in this choppy period. This system probably isn't going to work very well in a sideways choppy period here on this. All right. So that's how you can back test stocks there. You can go back, think of your system, whatever system you have. In this case, I'm just demonstrating the 1030 crossover system. You can go back in time for whatever stock you want, and you can zoom in. You can just kind of blindly find a spot in time that you want to do, and you can do your system there. That is what backtesting is. Now, let's address any questions you have. Does this work on simulation, thinkorswim? In other words, does this work on paper money? Yes, this should work on paper money. What I'm showing right here doesn't matter. This is really easy. But even thinkback, which I'm going to show you in just a bit, which is going to be used for options, should work on paper money. Okay. Now, do you see the problem with options? If I say, oh, I got in on a particular day, I can look on this chart here and find the stock data. I can find the stock prices for that day. But that doesn't tell me anything about how a long call is going to do, or a short put, or a butterfly spread. So that's one of the powerful tools of thinkback, is doing it that way. Okay, you can look at different time frames, you can look at historical data here, and you can find the entry points that you want on this. Okay, so let's do it. Let me just go and say, hey, we're going to use this system and I'm going to get in on a cross, a bullish cross here, and I'm going to use closing prices. Okay. One of the shortcomings, if you will, if you want to call it that, maybe it's a shortcoming, maybe it's not, is when we start talking about these, I'm not using intraday data. I'm going to use end of day data. And that's what thinkback uses, end of day data. But I'm going to find my day here. And so we actually missed a big candle day here on this, but I'm going to do that close right up here. So I'm going to find where I closed, and I can just look at the top of the chart, and I'm going to find that day. And I can find what the price of the stock is, but that doesn't really matter right now because I'm going to do an option trade now. And my day was 3/16/23, 3/16/23. So that's my date, March 16th of 2023. I'm then going to go to the Analyze tab. I'm going to go to Thinkback. I'm going to go to Google or Alphabet. Okay. And what I'm going to do is I'm going to put in the day that I was entering the trade there on this. And so in this case, we said 3/16, March 16th of 2023. I'm going to click on this little calendar, or you can type in the date there too, either way. But let me just do this. Let's go to March 16th, 2023. And did you see what happened? This just flashed up there, right up here. Let me just close that down for a sec. Make this a little bit bigger for you. Now look at these options. If I look at a current options chain, everybody, these options wouldn't show. These options have long ago expired. These are history. But this is our way back machine, as Mike put it in the chat. This is our way back machine into, in this case, back about a year. Well, a year. Wow. We're almost done with 2024, folks. We're back a year and a half. These are the options that are available. So you need to come up with and decide what strategies you'd use. So for our purposes today, I thought we'd compare a few. For a bullish trade, and I'm going to start off with a bullish trade, I want to compare a long call and a short put. Okay, and this is where, if you don't know much about options, maybe you can learn a little bit about options here on this. A long call is maybe a little bit more of an aggressive trade. And for our purposes, I need to decide how far out am I going to trade, okay, and what strike price I'm going to pick, okay. In this case, for both of these, I'm doing a shorter term trade. I'm going to go out, I'm going to look for the monthly contracts that are between 30 and 40 days out, or whatever's closest to that, okay. And when I do these, I'm going to put a 50% stop in each. Now, these are both single contracts. So a long call or a short put is just doing one contract, one leg. We'll do a short call vertical later where we're doing two legs. But let's start here. And so I'm going to do a long call. Now, we said 30 to 40 days out, monthly contract. I've got these right here. Okay, so I'm going to go out here. Oops, not that. And this is 36 days out. And I'm going to, for our options, for our long options, long call, long put, I'm going to go to a delta of 50 or whatever the next highest delta is. So notice these are the deltas that are available at the time. If you just pull this up, if you just walked up to my computer screen and you looked at this option chain, if you weren't careful, you'd think this is the current chain. You can manipulate it just like you could other options chains. You can add different columns. I think the default has this in there, but if it doesn't, you can always go up to layout, and this is showing you the option Greeks that were available at the time. So I'm going to go to that delta, and we're going to say that 58 delta just in the money, and I'm going to click on the ask price just as I would if I normally did it, okay, as I'm doing that trade. Let's see, okay, so let's do, hold on a sec, what happened? I had a past trade in there, you just got to be careful on that. Okay, here we go. So here's my trade. Now, this is the date up here that was how far back in time I wanted to start the trade. This is where I'm going to change it down here, bottom left, to the date that I want to see what the profit or loss is, or if I want to, well, we can see, or if I want to exit, we're going to find this out. Now, I'm going to assume I'm going to do like essentially a 50% stop. So I'm going to get out if we've lost 50%. Okay, that's going to be my downside. I'm going to get out on the downside if I've lost 50%, or I'm going to get out and we're going to say 7 days till expiration. Okay, a week until expiration. Those are going to be my exits there. Okay, those are going to be my exits. All right. So now, could I do a technical exit? Yes, I could. I could go up here and I could say, we can scroll forward and say, well, I'm going to get out if we cross below a certain moving average. Yeah, we could do that. I'm not going to do that in this case. I'm just going to do this and do the trade as we had it outlined there. So you can do a technical exit if you want. So, okay. So let me go back to our Analyze tab, and let me go here. All right, now let me address a couple questions here before we go. Sim, by the way, Wiley, thank you. In our chat, Wiley said, "Hey, our Getting Started with Options class occurs on Tuesdays." Okay, it does. It's Getting Started with Options occurs on Tuesdays, and Barb teaches that class. Okay, wonderful instructor, great way to learn options. I'm going through some more basic strategies here today for the most part. And if you want to learn more about those, make sure you check out that class. Yurik says, think back and on demand. Some of you may notice on your live platform, there's an on demand feature, which will allow you to do some essentially back testing. The advantage of the on demand is it gives you intraday type data that you can look at intraday. Okay, that's the advantage of on demand. Thinkback is a more robust tool that in on demand is only available on the live platform, not on paper money. Thinkback is available on both. For longer term back testing, I think Thinkback's the way to go. But if you want that intraday shorter term type trades, then on demand, absolutely you can do. Now you're going, Brent, I thought this is a paper money you're doing here. This is a paper money platform, but as an instructor here, as a coach here, they've given me basically a paper money platform that kind of mimics the live platform. So for the rest of you, you're probably not going to, if you're on paper money, you're not going to see on demand sitting up there. All right. So let's go here. Let's go back to our trade. And I clicked on it already. I clicked on the ask price. Here it's showing, remember, 50% stop loss. I'm buying it here for $510, essentially. So if I lose half of that, if I lose $250, I'm going to get out of this trade. I'm also going to get out with 7 days to go till expiration. This expires on April 21st. So April 14th, I'm going to get out. I'm going to go forward in time here. Look, I'm clicking my date forward. Now, as I do so, what I want you to notice is right over here on the right. Do you see this? PL open. It's telling me how well this trade is doing. Okay, so when I hit that $250 loss, $250 loss, I'm going to get out. Well, so far, it is doing just fine. And we're profitable, a little less profitable now. It's going down a little bit. And we said if I get to April, what did we said? 7 days before that. So April 21st of April minus 7 is April 14th. We're going to get out. Okay. So let me do that if we don't hit a loss before then. Okay. So you can see my profit or loss is fluctuating up and down. Okay. So I'm going to keep going. And I still have a profit April 14th. Okay, I'm going to get out here at April 14th. Our profit on this trade was $830, end of day data, right? $830 profit. Okay. Now, it could just as easily have been a loss. I'm not trying to say that this, this kind of makeshift system I'm showing you is one to follow necessarily. I'm trying to demonstrate think back, but it's a way for you to test your own system. 830 profit. Now, one other thing we can do is we can compare different trading strategies, right? Let's do the same thing, except in this case, actually, before I do that, we're going to do a short put. But you can also, if you're interested, you can kind of see down here your profit or loss. Let me zoom in here on this if it'll let me. Okay. Here's the trade. This yellow-orange line represents my profit or loss. And we got in on the 16th. And you can see our profit shoots up. It's a little gappy sometimes. I don't know why we're not seeing anything here, but and you can see the profit or loss as time goes. Okay, so you can use that as well, but I'm not going to focus on that too much here. You can play around with that. But let's try a different strategy. And what I can do is we can also do a let me go back to 3/16, March 16th. And we can also do this for a short put. Now, for my short put, I'm going to go closest to 30 to 40 delta. Well, there's my 42 delta. I'm going to sell that short put. Again, I'm going to do a 50% stop on there. And my 50% stop, well, my initial trade, my initial credit on this is, we'll say $350, $175. If I lose $175, I'm going to get out of this guy, okay? And I'm going to use my same exit rules on this. So again, I can do this. Now, the reality is I could actually do them both at the same time if I wanted to. But I'm going to go for it. And we're profitable on both. I don't think we're going to hit our stop loss on either one because it's a pretty successful trade. And we said on for April 14th, okay, how much should we make on our short put? Okay, well, I made $340 on that. Now, I am not including commissions on here or transaction fees. 340 profit. Now, does that mean that the long call is a better trade than the short put? Well, in this case, in hindsight, the long call was turned out better. But remember, there's pros and cons to any kind of strategy you do. The long call, if the stock really goes up a long ways, is probably going to do better than a short put. If the stock kind of stays sideways because of the role of time decay, which benefits short puts and hurts long calls, if our stock just goes up a little bit, or if it goes sideways, or maybe even goes down a little bit, we're probably going to be better off that short put. If it goes down a lot, we're probably going to be better off with the long call than the short put, though. Remember, short puts can be assigned early as well. All right? So let me do that. So here's what we did. You can throw in multiple trades here if you want. You can test the different types of trades. And what I hope, my goal is, as I'm going through these different types of trades, you're learning how to use this think back function here. Now, when you go to some days, when you look at it, what it's going to do is it may zero out like on your profit or loss or something. It's probably just a weekend day there. Okay. So good question from Priya. Priya said, don't I have to reduce what I paid for it to get the profit on this? So the answer is no. And here's why. And that's a great question, Priya, by the way. That is a great question. And the answer is, I don't know what day I'm on here. This is a PL open. This is a PL open that's displayed here. This is not the cost of selling it or the price we get for it when we sell it. Because look, if this were the price we were selling it for, we'd actually be at a loss on this long call. We bought it for 512, okay? What this is basically saying is we bought it for 512 and we're selling it for 370 more than that, which is approximately, I'm just going to round, is approximately 880. Okay. This is a profit or loss. It is not a sale price on that. It's a good point though, because if you're using something like, say, the Theo price tool calculator, which we've shown in the past in this class, you have to consider what you bought it for and subtract what you sell it for. So there we go. Great question. Let's go forward and because I want to show you that we're not limited to just long options. You're not limited to just single options either. Okay, we can do spread trades on here as well. Okay. So Eureka says, I understand the tool takes in the daily closing price. Okay, fair enough. What if the day was super volatile and the target actually touched, but the close went back to the open price? Well, that's the deal. You're still doing the closing price. So if you have let's say you have a stock that's kind of, I'll do candles here. There's all red candles, but the stock's going up, and the next day we have like a target price up here. Okay, and intraday it goes up. We'll say that's the high of the day up there. And this is the low of the day right here. And this is also the close of the day. Okay. Big shooting star or something like that. Well, that is a limitation on thinkback. However, I would also suggest, yes, you can automate an exit if you want on when to get out. But for a lot of people, the challenge is you're not looking at it throughout the day. Okay, maybe there's some of you out there that are, and so yeah, that's the challenge of that, and that is a shortcoming, Eureka. If you do this, this is using daily closing prices. All right, good point though. I'm glad you brought that up. Okay, I'm going to close this. I'm going to get rid of this. Let's switch up stocks. How about and just find a different stock? I'll just go to McDonald's. McDonald's actually has earnings, I think. When's earnings on McDonald's? It's coming up pretty soon. October 29th. Okay, we got a little bit before earnings here on McDonald's. But so let's do McDonald's. Let's go back in time. Okay, I'll just do that, and we're going to find a new entry. Okay. Let's see. Oh, actually, you know what we're going to do? We're going to do a bearish trade here. Let's do a bearish trade. So this was our bullish trade. And here we're going to do a bearish trade. Let's compare a long put and a short call vertical. So this will be a multi-leg option strategy. Now, I'm not going to go into all these different types of strategies, but I want to show you at least one multi-leg. And I also want to give you bearish examples here on this too for your trade. But for our bearish position, I'm not going to be looking for a cross above of green above the red. I'm going to actually be looking for a cross of the green below the red. So let's go forward. I'm going to zoom in just a little bit so I can see it a little bit better here. Make it a little bit easier for you guys to see here. Okay. And I'm going to go forward until we get that cross. Okay. I'll go one day more. Okay. Here's my cross. Here's my bearish cross. And that was on 6/10 of 22. 6/10 of 2022. That's our entry, our bearish entry on this. Again, these are just examples, folks. They're not recommendations. Well, I can't recommend this backward-looking trade anyway. But just remember, you can backtest these, and they may work out pretty well. Doesn't mean they're going to work out in the future. But keep in mind, as you're back testing, you want more than just a few data points on it. It's not really a super valid sample size if we have 4 or 5 trades on there. Okay, we want many more trades than that. Maybe 30 trades would be great to use if you're trying to see how some of these systems work. Okay, so let's do it. Let's see. I jotted the price down. The date down was 6/10 of 2022, and we're on Mickey D's there. So we're going to go to Analyze tab, McDonald's. We're going to go to thinkback. Let me do MCD here. MCD. Here's McDonald's. I got to go. First step, remember, I got to go to my date. And it's 6/10 of 22. So let me go back to 6 is June 10th of 2022. That's a Friday. By the way, if you click a day that's not a Friday, or not, that's a Saturday or Sunday, or maybe a holiday, it will not say, it should flag you on that. Let me go to 6/11 and see what it says here. See, it says non-trading day. Okay, it says non-trading day. So, but we're on a trading day, and I'm going to use similar rules to what I did on the initial one. On my short call vertical, I'm not going to use a stop though. Okay, no stop. And so long put, I am going to use that 50% stop. I'm going to do a similar thing in terms of days till expiration. We're going to go 30 to 40 days till expiration on these. I'm going to go 50 plus delta on my long put. And on my short call vertical, I'll go, we'll say whatever's closest to, we'll say 30 to 40 delta. Okay, something like that. Okay, so let's do that. So I'm going to do a long put here. And for that, I'm going to go out 30 to 40 days to expiration, whatever I'm going to use the weekly contracts here. And of course, it's using my normal caveat with options is make sure you have liquid options here. I've picked a couple companies that are bigger companies that tend to have more liquid options, but just be careful. You can often tell by looking at the bid-ask spread on this. In this case, we're looking at puts, and we're doing the 50 delta or higher. Well, that's a 41 delta. I'm going to go to this 65 delta. I have a 1050 bid, 1085 ask, and I'm just going to click on that ask price. There is my long put trade. Right? Now, I'm also going to do, we'll do it at the same time here, I'm going to do a short call vertical. So I'm going to go up here, and before I do that, I mean, I can switch this to vertical, but if I'm using delta, I'm using the delta on the short contract. For me to get the delta on the short contract, this delta right here is displaying both the net delta between the long contract and the short contract. So I'm going to start with just a single. I'm going to find my delta, and I said I want delta 30 to 40. Well, I don't have a delta between 30 and 40, but I'm going to do it anyway. I'm going to go to a 41 delta here. So 240 is going to be my long, 230. Sorry, wait a second. This is a short call vertical. So I'm going to go over here. I have a 30 to 34 delta. We're going bearish here. 250 is going to be my short. 260 is going to be my long. 250, 260. I go to 250, 260. I'm going to sell this. Okay. And now I have 2 trades in there. Okay. I have my long put trade, both bearish trades. I have my short call vertical, and we're going to go forward. And again, I'm going to use a 50% stop on this guy, and we're going to get out 7 days till expiration on these. Now, the reason I'm not using a stop on this, well, because it's a spread trade, and that inherently limits the risk somewhat compared to just doing a straight, well, it limits the list considerably compared to doing a naked call here, which is if I just sold the 250 is what we'd be looking at. So I'm going to go forward in time, and our PL open, okay, we're actually profitable on this one as well so far. We'll see. And 7 days before expiration is going to be July 8th. Okay, I'm maintaining profitability. Okay, we're at a loss now. Am I at a 50% loss? I'm down 160 bucks. No, I'm not at a 50% loss. This is an expensive long put. It's a more expensive stock. And so my loss is going to be about $530 would get me out. Okay, that's going to be my stop loss, my 50% stop loss. Now you can put a tighter stop loss in if you want. That's no problem. But for our rules, I'm using that 5. Ooh, we almost are getting stopped out on this long put. Okay. We're down on the short call vertical. We're looking for that. Okay, that was probably a weekend there. 465. We're flirting. Oh, that's actually improved a little bit. 510. What did we say? We said about 530. We're right on the edge of being stopped out. Okay, still not. Okay, there we go. We're stopped out on this. Okay, we're stopped out on this. Okay, and Sim made a point in the chat. I could, if we truly put in a stop loss, a 50% stop loss, we likely would have been stopped out intraday on that, which likely would have been a good situation. Remember, whenever we talk about stops, though, they're not guaranteed to get us out at a particular price, right? That's when they trigger. We don't know exactly what price we're going to get stopped out on. But for our end of day pricing, this is going to get me stopped out. Now, so we're down 800. We lost $802. Lost 802 here on that one. And let's keep going here. I'm not using a stop loss on this, and we're going until 7 days before expiration, which is going to be June 8th. Not July 8th, excuse me. I'm just going to go to July 8th. We lost 210 on that, okay? So we've seen a bullish trade, we've seen a bearish trade, we've seen a successful trade, we've seen a very unsuccessful trade, and that was 210 we lost on here. So judging from this gives us kind of a demonstration of what I was mentioning earlier. If it goes your direction, those long calls and long puts can certainly make a lot of money. But if it goes against you a little bit, or then maybe not, maybe some other trades here. In this case, we had a short call vertical, and we've lost $210 on this. In this case, this would have been the better trade between those two. But that's not the point here. The point isn't which trade in this case was the better trade. The point is, this is a way of going through your approach to trading and testing out different approaches to trading and deciding whether your system, when I say system, your rules that you're using to enter and your rules that you're using to exit are ones that you want to, that find valid enough. Maybe if you do, maybe you switch to forward testing. But do you see how by going back in time, we can get a lot of data points on a particular system that you're using in a short amount of time, and then decide whether you want to investigate it further. And some you're going to look at, and out of hand, you're going to go, boom, I do not like that. It doesn't seem to make sense to me. One other thing, when you're going back in time, don't always use the same date, okay? Because if I go to a particular date, let's say I go to, I'm just to make something up, let's say I go to May of 2020, okay? May of 2020. If you remember that, a lot of you have probably blocked out that whole year, 2020. But remember, COVID hit in March. The markets screamed down for a couple months or something like that. And then they went on a pretty bullish streak. If I pick 10 random stocks there, but I use May of 2020 on a long trade for each of those, I'm probably going to go, this is a rock star system. I can hardly lose with this thing. But it's not the full picture. Okay. Similarly, there's points in time. If I go back to, say, February of 2020, I'm going to say this system is junk. It doesn't work. So make sure you spread out different securities, different dates. Okay, just even for stocks, different securities, different dates. And for options, same thing. This is the way you can backtest them though. And if you want to compare one type of strategy to another, you can do as we did and compare one type of strategy to another. Now, I'm going to check questions here because I'm running low on time, and then we'll see. Okay. So Sim said, Sim prefers stop limits to stop market orders. Remember I said stops aren't guaranteed to get us out exactly where we intended. Well, the advantage of a stop limit order is we may not sell it for less than we hope, but it's also possible they don't trigger at all. Okay, that's the downside on stop limit orders. I'm not saying one is better than another. It's a preference. There's pros and cons to both, and I appreciate you bringing that up there. Also, Sim said, hey, be careful with higher volatility during extended hours. If you do extended hours trading, these trades are not taking advantage of, do not factor in extended hours trading there. Okay, let's see. When you do this kind of test, this is from Aileron. When you do this kind of test, does your paper money is used? You can use paper money or live trading. Either way, you can use your live platform or you can use paper money. Either one, they should look the same. Either way on that. Okay, no difference there. All right, so what we do today, we talked about backtesting in general, the importance of creating a system, and backtesting specifically with stocks. Remember, you can do that primarily just from the stock chart, and backtesting with options. The first key is to come up with a set of trading rules that's going to govern when you get in and when you get out. You have to know that before you backtest. Your backtesting isn't going to do anything if you don't know when you're going to get in and get out. It's not going to give you any valid data for testing your system. So what I would suggest for you, what I would ask of you, implore you even, backtest, try this, and see if it's helpful for you in coming up with a system that seems appropriate to you, because there's a lot of different ways of trading, folks. I'm not recommending any one particular way for you, but there's a lot of different ways, and see how it works. Okay? Thanks for joining me today. Coming up next, we have generating income in your portfolio. I want to thank Barb for helping me out in the chat, of course. And I want to thank each of you for helping me out today. Bree and everyone else in production, thank you very much for helping us out. And we will see you all same time next week. Bye-bye, everybody.